Hi, welcome to the It's Your Money and It's Your Estate Spring 2025 Workshop Series, brought to you by our 501c3 nonprofit organization, Financial and Estate Literacy. Our mission is to empower you to take control of your finances, your estate, and your charitable giving decisions. For the past 25 years, our founder, Peter Kote, as well as our entire team, have been providing these free, unbiased, and accessible 6-week workshops all over Orange County, California, as well as online, to help you make informed decisions that align with your unique needs and values. Now let's take a quick look at our website, iyme.org. On our homepage, you can easily view our schedule, which has all the information for these webinars, as well as the in-person workshops. You can also register for these webinars straight from the homepage. Now, if you click Workshops and select the series of your choice, you'll find the topics for each of the weeks of the program. Each of those pages will have the recording of the webinar, which is usually posted about 3 to 4 days after the live webinar airs. Underneath that, you'll find the general workshop documents, which are our workbooks, which will guide you through the series, our booklets, as well as the very important Ask First form, which is very useful anytime you want to retain someone's services. Depending on the location where you take our classes or whether it's an online webinar, you'll find the speaker's presentation as well as their signed Ask First form. If you scroll all the way to the bottom, you'll find a selection of updated articles curated by Peter Kote, which are relevant to the topic of the day. Lastly, I want to go to our sponsor page, because without the support of our charitable sponsors, this program would not be possible. Now, let's start the program. This webinar is the first session of the It's Your Money 6-week program. The topic for today is Overview and Tax Changes. Our moderator is Peter Kote. Our guest speaker is Laura Tarbox. And this webinar is brought to you by Mary's Path. Enjoy the workshop.
Laura, come on board.
I'm trying. All right.
There you are.
Hi, good morning.
Good morning. Laura, you are first of all, let's bring up your Ask First form.
All right. Let me do.
There's a blank Ask First form on your on our website, and we use this Ask First form to interview presenters, and you should use it for interviewing professionals, anyone who's going to be working with you with your money. Number one reason when I was at Long Beach State University for people to hire an advisor was because they're nice. And nice is really important because you got to communicate, but you want to know a little bit more about them. So let's introduce and go through Laura's Ask First form in detail. Bachelor's degree from UCLA, all
Yes.
those from USC, no worries.
I'm sorry.
Yeah.
Third generation UCLA, I will say.
Yeah. So you have what's called a CFP. What does that stand for?
But you're not going to beat me up for my major at UCLA?
No, I'm not going to beat you up because I think communication is important and writing skills you have.
I was an English major.
Yeah.
Confessions.
Yeah.
Yes.
So what is the CFP? And how did you get into the world of financial planning?
Yeah, so I was out of school with my English degree trying to figure out what to do. Like my parents warned me what happened, and met somebody who had just left a big brokerage firm to start his own independent business. And I went to work for him. And it was still very much on the sales side, which I didn't love. I loved the financial world, but I didn't love the sales side. And I discovered the CFP program pretty early on and got very excited about the idea of holistic, comprehensive financial planning.
What does the CFP stand for?
A certified financial planner.
And did they just hand that out to you when you went? What?
They didn't.
How do you get it?
It was
Huh?
easier back when I got
Yes, I
a
know.
little bit, but it's a typically a 2-year educational program that you go. There are approved educational institutions that provide the curriculum, and after that, you have a comprehensive 10-hour, 8 to 10 hour exam over a couple days. I'm not even sure how long it is now.
Yeah.
That tests you on investments, insurance, estate planning, tax planning, cash flow management, employee benefits, and kind of how that all ties together. So it's a
Yeah.
rigorous test. The passing rate is not particularly high. I think, I'm not sure these days, maybe in the 40-50%
I
range.
think so. Yes.
So it's become a pretty rigorous program. You have to have experience before you're allowed to use the CFP license. And it
And
is,
you were also an instructor at UCI for the
yes.
CFP designation.
Yes,
By
I
the
was the program
way,
director at UCI for over 20 years, so I have taught over 1,000 CFPs in this area, also taught at UCLA, and also taught at USC.
yeah. So why are we focusing so much on this designation? How many designations are there in the financial services industry?
Many, many, and new ones all the time that sound impressive. And we'll
Yeah.
get into that a little bit more. There's only a few that really have much meaning. If you are saying that you're doing any financial planning or wealth management, you should be a CFP. You should be working with a CFP.
Yeah.
It's
It's kind of like a basic degree.
It is, though it isn't mandatory. So you can call yourself anything, practice any which way, but CFP is a step in the right direction when you're choosing an advisor.
And that's the point. Anyone can call themselves a wealth manager. There's no rules on what you call yourself. You can call yourself a financial planner. It's perfectly legal. The other issue that I wanted to bring up is that is the financial services a sales world?
It is a sales world. It's to this day. It always has been. As I was saying just briefly, I was uncomfortable with that side of the business. And round about the late 90s, a new way of working in our industry and our profession came about where you could work just on a fee basis and not sell stuff. So I
Okay.
was pretty early in that transition. And I thought, certainly within 10 years, the sales side would be fading off into the background, and not true at all. It very much dominates the industry, and it doesn't, and it's not always easy to tell when someone's trying to sell you something. It's not always
What are the products and what do you mean by selling?
yeah, so selling mutual funds,
Okay.
annuities, selling wrap accounts, selling private real estate investment trusts, private REITs, selling limited partnerships.
And most of these products come with a commission tied to them.
Yes, commission and typically high ongoing fees as well. So there's a lot more money on that side of the business, especially initially, and without a lot of work. Once you sell the product, you're not necessarily even giving ongoing advice or taking care of the client.
It sounds like a car lot.
Can be. Can be. And one
Yeah.
of the things for me is, having been in the industry as long as I have, and taught so many CFP students, and CFPs could be selling stuff or not. So CFP isn't the only screen. It's a very different it's a very different way of doing business, and it's a different type of person who finds themselves in one place or another. I've tried to hire people out of what we call that the dark side. The brokerage firms, the banks, the independent broker dealers like the LPLs and
Credit unions.
credit unions, Edward Jones, on and on and on, all the Raymond James, all these firms. And the kind of person that typically stays in those type of firms. Some people go there and they realize it's very sales focused. It isn't at all what they thought as far as giving advice to clients, working with them on their financial stuff. It's more about being the number one salesperson. There's huge focus and attention and pressure to sell a lot or to gather a lot of assets. And so successful people find themselves there, but it's more about themselves. It's more about, I want to be the number one salesperson at my firm. And that person doesn't make it in a real financial planning firm.
Approximately how many clients do you have?
So we have about 120 client families.
Okay. And then what is a typical somebody who works for an LPL, a broker for Merrill Lynch, Morgan Stanley? How many clients do they have?
So a single advisor could have several hundred clients. So
In
we
the
have,
thousands?
and sometimes thousands. So we
Yeah.
have 120 families, and we have 12 people here at the firm.
Regulation, we're going to talk about more in the presentation, but just relevant licenses. There's a Securities and Exchange Commission, and there's a group that works under them called FINRA. Talk a little bit about you have no license. Are you allowed to drive or?
Yes, so that is, actually a plus, because if you have licenses, most of them just allow you to sell things. So there's certain when people are starting out in the industry, there's typically a Series 65 license that they need, and that's okay. That just allows them to be
It's
an
more of a
investment advisor.
registration.
It's more of a registration. No, but the 65 is actually a test. But
Yeah.
if you're a CFP, you can get grandfathered in on that, and I got grandfathered in on that. But a Series 7, other licenses just enable you to sell stuff. And in the late 90s, I gave up all my licenses because I didn't want to sell things anymore. So you sometimes will see these people with all their licenses like it's a badge of honor. We think it's a badge of shame because there's a lot of conflict of interest, and you really have to be careful working with someone like that.
Yeah, and all the regulations that there are about how to ethically sell.
Right.
You know?
Yeah, well, and it's crazy because it's exactly kind of how you can trick people, but disclose it in really fine print in language you don't understand. And there's more and more regulation on us every year, and it's really frustrating because it's regulating, it's meant
Sales.
to regulate the bad, the bad actors, and yet we have so much compliance and regulation and audits. We have three different, because of how we work and some of the things we do, have three different agencies who can audit us at any given time.
You do not practice law, but you go through somebody's estate plan, and we're going to go through that in your presentation. We're going to probably beat this term up through the 6 weeks, but talk about in our business relationship. What does that mean?
That means anything all the time. I'm not just going to wear one hat and walk in the other room, put on a different hat. Say, now I'm a fiduciary, but over here I'm not when I'm trying to sell you the annuity.
What does a fiduciary mean?
Fiduciary means you're putting your client's interest before your own. And yet, and that's what you want, of course, but the brokerage firms and the banks have found ways around that. So you see them use that word, and they are definitely not fiduciaries all the time. So that's the thing. Are you always a fiduciary when you're
So
working?
how can you tell when they're not and when they are?
So you mentioned earlier, Pete, FINRA. So as an investment advisor, we're regulated under the SEC, but if you have licenses and are selling stuff, you're also regulated by FINRA. And we'll show you how to go to the website to check that out. But FINRA, if you have a FINRA affiliation, like when you go to somebody's website, go to the bottom and see what kind of affiliations they have. If they're with any brokerage firm, bank, or if FINRA, there's a FINRA notice, that means that they're able to sell you stuff and not always acting as a fiduciary.
Yeah. And every single person who's in wealth management needs to be registered with FINRA and the SEC. So we'll show you how to go about looking people up, because it's really important in this area to do so.
Right. Not only to see whether they have these licenses, but also that will show you if they have any disciplinary things on their background. And most people on that side do. I mean, many people do. I probably
shouldn't say most.
And the big firms have thousands of pages of disclosures and fees they've had to pay and penalties for all the stuff they've done. And of course, a firm like ours, if we had even one, we would, it would be hard for us to do business.
Yeah.
So you can find out what kind of disciplinary stuff they have. But also, just because there's nothing on there doesn't mean that they haven't had it in their past. But of course, there's a whole industry of lawyers that these big firms employ to wipe people's records clean. And which is just crazy, but that can happen too.
It's a treacherous world.
Yeah.
In the world of money. How do you charge your clients?
So fees are paid only by the client, either as a percentage of assets that we manage directly, or as a fixed fee for some work we're doing, in some cases an hourly fee. No fees paid by a brokerage firm to us, no fees paid by a mutual fund or insurance company. And also we don't share fees. So one of the things that happens in the industry that ticks me off a little bit is a firm like mine has to work with a custodian, with a brokerage firm, to enact the trading that we're placing for clients. So we would have to work through a Schwab or Fidelity. Those are the two big players in the independent space. And those firms are split between institutional, like they work with advisors like us, and retail. And on the retail side, they do different things, which is interesting. So kind of two separate companies within one company. So one thing to understand, because the offerings and the pricing are different in those two worlds. Like in institutional, we tend to get better pricing than retail pricing. But more importantly is those organizations refer their retail clients to advisors and take a cut of the fee. Typically Schwab just upped their fees. It's about 0.25%. So
annually for the life of
the life. So Schwab would own the client, and we had decided a long time ago we never wanted to be beholden to one of those firms, because we want to be able to switch if we don't like them. Also, now those firms, Schwab and Fidelity, only refer the biggest firms that are good salespeople who can close the business, and they aren't necessarily the best firms. The smaller boutique firms that tend to be the best firms can't even get in the program, because you have to have like a dedicated person who goes to the branch to solicit people. We've had them use that against us, where they said Tarbox couldn't get in the program. No, we don't want in the program.
Yeah. And people have an impression that bigger is safer.
Yeah. No,
it's not in the financial world.
But there are things that you need to pay attention to be sure you're safe and you're working with a legitimate boutique firm, and we'll get into that a little bit.
Yes. So do you have a minimum that you will accept as a client?
Yes,
investable assets.
We have a minimum of 5 million investable assets.
And what is a typical on 5 million? What do you charge?
We're typically charging 0.85%.
0.85%. And is that paid quarterly?
It's an annual fee that's broken out over 4 quarterly. Yes.
And do you does the client know exactly how much they're paying you on a quarterly basis?
Yes, they get statements every quarter. They'll see it on the brokerage statements, obviously disclosed fully to them. And that's the only fee that we get from them.
I guess
occasionally the Schwabs and Fidelities might have some ticket charges, not very many on the institutional side, but maybe like a $19 charge for investing in a certain mutual fund or something. But we don't get that. That goes to the brokerage firm.
I've reviewed Merrill Lynch statements and Morgan Stanley statements, and I cannot find what I pay or what the client pays the broker. Is that normal?
Yes. It's very difficult on that side to find what you're paying. And you're paying the broker, you're paying the firm. A lot of times you're paying the issue of certain things that they're putting you in, certain investments they're putting you in. And you're also, the person you're working with is working for this brokerage firm that's making a lot of money on the cash balances, for example. There's a lot of different fees going on in those big firms, and it really isn't easy to figure that out.
Yeah.
And of course, there's a whole other set of disclosures that they're requiring that's supposed to to tell you that, but you can't really figure out what's going on. So,
You know,
Weston, we say just like stay away from it because there's other good options.
On the box, it says ways I'll be paid. And the only way you're paid is going to be by the client, means your loyalty is only going to be to the client.
Right.
And then payment will be made by. Okay. Now that shows if I was working for Merrill Lynch, for example, as an advisor, then Merrill Lynch would be paying me.
Right. And
So,
the mutual funds are paying Merrill Lynch, and the insurance products, the annuities are paying Merrill Lynch, and then Merrill Lynch pays the broker.
yeah. So that's why we have that box kind of split so that you can understand that the loyalty is to the client, to no one else, because the only person that's paying you, Laura, is the client.
Yes, and this is, this really is a form that just cuts through a lot of the stuff to give you what you really need to know. And we've seen where somebody would bring this to a bank, a trust company, a Northern Trust, whatever, and they're not allowed to fill it out. So that kind of tells you a lot.
Yeah. Was there anything offensive about this form?
To me? No.
Yeah. Yeah.
No.
How long did it take you to complete?
60 seconds, maybe.
Yeah. Yeah. I've had people actually come back and say, "Can I ask this of my financial advisor?" And I go, "Yes, it's your money. You're the one that's the employer."
Right. And having been on the dark side a long time ago, there's so many, like the big firms, those banks and brokerage firms, they do sales classes, not financial planning classes for their employees, and you're taught to intimidate people, to kind of scare them into why they need you, and to not make it very clear to them what you're doing and how you're paid and all that. And so people can be intimidated, and you shouldn't be. It's obviously your money. It surprises me how often people don't really ask some of these questions. Very important.
And what happens as well is that you get overloaded with information.
Yes.
Who reads a prospectus?
Right.
And that's full disclosure. That's the one requirement of all people in the financial services industry, is full disclosure. So for financial advisors such as yourself, how talk a little bit about your ADV form.
Yep. So the ADV form is the form that all registered investment advisor firms file with the Securities and Exchange Commission, available online to everybody, that has a lot of disclosure. It will tell you, are they running a real estate business on the side? Are they selling insurance? Do they have a law firm under their wing? Who are the principals who own the company? All that sort of stuff is disclosed. With those bigger firms, they're so big and long and intimidating a lot of times because there's so much disclosure, because they're doing all kinds of crazy things. But it should be a pretty succinct form to go through, just to tell you what's going on and who's involved.
Yeah. And so every person such as yourself needs to have disclose that to any potential client.
Yes.
Then the next line says financial products or affiliated organizations. Laura, are you associated with anyone that you get a kickback from on annuities, mutual funds, or other financial products?
No, and this is a big one, because there are people out there that say they're not supposed to. They say they're fee only, and they'll say they're fee only on the investment side, but then they do insurance on the side. Like, they can sell you annuities and life insurance and say they're fee only. It's a little bit of a loophole. CFPs can get in trouble for doing that. But if you're not a CFP, the California Insurance Department regulates insurance, and the SEC doesn't really get involved in that. So I feel like it's a little bit of a loophole where people can be selling you annuities. And I don't know if I have this anywhere else, but I will say, do not find your advisor at a free dinner or from somebody you heard on the radio. That the good advisors are not getting clients that way.
We're going to get into the presentation just a little bit, but this is the overview and the introduction. And so you have a minimum of $5 million. I don't have $5 million. Does that mean that if I go to a financial advisor who doesn't have a minimum, am I going to get less of a service?
No, not at all. There are many advisors who have lower minimums, and there are a handful of advisors that we know locally who do a great job who don't have a minimum.
Yeah,
And
because the process is literally the same
the
no
process
matter
should be
what
the
the
same.
size
And
of the
we're
estate
going to
is.
go through what the process
Yes.
exactly. Yep.
Yeah. And even if you don't want an advisor, you want to do it yourself, use the process for yourself.
Yep.
I think it's harder to do it for yourself. I think it's easier to do it, have somebody else help you. But if you are stuck on wanting to do it on your own, follow the same process and it'll help you. And the 6 sessions that we're going to do follows that process as well.
Right.
So hopefully that after you get through the 6 weeks, you'll have a better understanding of financial planning and staying in control of your money. Let's go do the presentation, Laura, unless you want to add anything else as far as the introduction of you.
No, thank you. I think, and just I will say, and if I don't remember to say at the end, I participate in this and have for since the beginning. I think, Pete, many
Yes.
many years, and I love it's the organization. I love doing this. I have one of my personal missions is to promote philanthropy, and that this is kind of goes a long way toward that, and also to promote the right way of practicing and doing financial planning and investing. And so I am happy to help promote the other people who participate, the other advisors who participate in these sessions. And if you want any input on how to pick an advisor, or anybody that you're talking to, I'm happy to weigh in on that, or give you a couple names if you don't, aren't interested in our firm or don't meet our minimum. So,
Yeah, and that's
and
wonderful.
there's
And
some great people in this program.
yeah, the, the whole charitable end of it, you can't gift to your family, you can't gift to charities unless you have a security that you're going to be okay. And I mean, it's like being on an airplane, and then there's turbulence and the mask comes down. Who do you put it on first? Well, you put it on yourself first,
Yep.
and then you put help out the children and help out a charity. But it's wonderful when you feel secure about having enough money that because one of people's biggest fears is having their lifestyle lowered or running out of money before they die.
Yep. And
And
it's complicated, as we've said, and it's sometimes complicated by design, unfortunately. And we're going to try to demystify it as much as we can here.
yeah, and fear is a great motivator, and many in the financial services industry promote that fear. And so you can't make good decisions based on fear. It's a good thing to make things aware, but fear is not a good rational. It's kind of like what's happening today. Uh, I've heard from a few people saying, I've got to get out of the market. Touch on that for just on the news that's coming out every day from Washington.
Yeah, it's crazy, extraordinarily stressful, and nobody can time the market. I mean, the last month has shown us that the huge swings in the market. For most people, unless all of your money's in a retirement plan or IRA, there are tax consequences to selling and getting out of the market. And it seems so certain that things are going in a bad direction. And I agree. I think they are right now. But that doesn't mean you should sell. You should design, you should design your portfolio in the beginning so it's set to weather times of volatility. And it's always a little bit different, and yet a lot of things remain the same. I mean, I always say the stock market goes like this. It's stair steps. It goes down a little bit. In the long term, it goes up, and it's the best way to make money. And if you design your portfolio so it can weather the downturns and just stick it out, you're going to be better off. And I think that's generally, what the advice that all professionals are giving you. To think that you can time it, it's just, it's just not possible. It's not possible for professionals to time it right. It's not possible for anybody really to time it right, because you have to figure out exactly when to get out, and then you have to figure out when to get back in. And unfortunately, the timing of your emotions and what actually ends up being a good time to get in or out don't coincide. So when you're feeling the worst, that's probably the time to buy. When you're feeling the best and you want to buy more, that may be the time to sell. And you got to take your emotions out of it, which is another good reason for working with an advisor. Vanguard, very well-known fund company, and they do a lot of other things now. They have a study that they've done for many years that shows the value of having a professional advisor, adding about 2.5 to 3% a year in your investors' returns, partly because the professional advisor is keeping them in the market when they should be the market, and
stopping them from doing crazy stuff.
Right.
Okay, because your mind, where do we learn about money? Well,
we don't.
Usually from family.
Much, yeah.
Yeah, from the Hard Knocks. There is no course, and every culture is a little bit different. Every family is a little different. Number one reason for divorce is money. War, number one reason is money. Resources. It's money is one of the most difficult topics to discuss.
And it's crazy that there isn't more education in our basic education system. I know the CFP board has tried to get that in high schools. They've had a little bit of success, but not too much. And even in college, in the MBA programs, it's not about personal finance and managing your money. It's hard to learn about it. And then you get out in the world, and most of the people trying to tell you anything or teach you anything or have
salespeople.
Have a conflict of interest. So there are a few places to go to learn about this, and where you can feel free to ask the questions that there's no dumb questions. So I just have to show this little thing. I had the most wonderful experience. I have one daughter. She's traditionally pretty bad. She's frugal, but she doesn't care about money, and she's bad, and she has no interest. And I have crazy stories about it over her life. She's 29 years old. She at the urging of her girlfriends, convened a women, wealth, and wine event at my house for 6 young women in their late 20s about money, to just ask because they all know me from high school, college, grad school, and they felt very comfortable asking questions. I put together something similar to this, thinking we'd go an hour. They went 5 hours and just asked me every little question. They said, oh my gosh, I was always afraid to ask Fidelity this. I was afraid to ask, my boss this, all this. So there aren't a lot of safe places, and this is a safe place. So,
one of the questions that we got is, do investments have expenses that would be in addition to the annual client fee you charge?
Yes, great question. Some do and some don't. And you'll have a couple sessions on investments that'll get more into that. There are, in mutual funds and exchange traded funds, there's some underlying fund fees that are also paid. You don't see those. They do disclose it, but that's embedded in the price and the values that they see.
But if a fee-only advisor is there to find those investments that are the lowest or the greatest value for the client.
Yep. And it's when your advisor is giving you reports, and actually a lot of the brokerage firms don't even really give you performance reports. They just give you statements. Most good advisors are going to give you a statement that actually calculates your return, at least on a quarterly basis. Or they may have a dashboard where it happens daily. They should be showing you that return net of fees. Yeah. And a lot of people don't. They kind of play around with that as well. So that's another question. Is this return net of your fees?
Yeah. And we're going to get into comparisons and all that kind of, it's a little complicated. Let's get into the program, Laura.
So this is an overview of the 6 of what we'll be doing. Today's the overview and a little bit on tax law changes.
Okay, let's do it.
Regulation of the industry, we've talked a bit about that, the financial planning process, what that entails, and then some tax stuff.
By the way, Laura could do the entire program, but we're not going to let her.
You have some work to do. It's a little busy right now, though. We got through April 15th. Yay.
Okay, let's get started on your outline.
So that just
you want to pull it up?
It it is up. That's what I'm sorry, it is up, but I wasn't sharing it with you.
Okay.
Or did you see it?
No, I see you right now, but I don't see the outline.
Okay, well, that's not good. I was sharing the wrong thing. Now, can you see it?
Yeah.
Yes. So I'm on whatever page this is. Yeah, so a couple pages in.
By the way, the entire outline is available for everyone on the website. So I don't want you to feel like you're not getting where she's starting right now.
Yep. So I'm just right in past the intro. This is what we're going to cover over the 6 weeks. Today is the overview, tax law changes and financial planning process. So just another comment, Securities and Exchange Commission, the RIA, that's what most of the people presenting will be with an RIA firm. The people who work for an RIA firm are usually IARs, the investment advisor representative. It's a registration that they have. FINRA, everybody has to do stuff through FINRA, but they regulate the brokers for the most part. And it's a self-regulatory body, which is always a little squishy. So a lot of times FINRA is accused of being very much on the brokerage side of the industry, which is kind of interesting. They don't really regulate any advice or financial planning. And then
please look up, if you have anyone that's acting as your advisor, look them up on FINRA. And the way you do it is just Google broker check, and it'll take you to the FINRA website.
And actually, I think I have that on here coming up too.
Okay, great.
Yeah, broker check is a good way to get there. And if you're with a true fee only firm, it's going to just flip you over to the SEC
website.
If you go to the SEC website and they're a broker, it's going to flip you to FINRA. Usually that works that way. So we've talked about being fee only, the pure fiduciary model, but there's lots of other ways. And all the brokers who are selling you stuff and insurance people, they want to be fee only. They know that's kind of a higher form, a better pure. I remember someone saying to me once, "You think you're so pure?" Because I dropped my licenses. Yeah, we try to be as pure as we can. But so they'll say, "I'm fee-based," which is a real red flag. Fee-based is not fee only. That means fee and commission. You could charge fees and commission. So fee-based is really a euphemism for fee and commission. So
in normal social conversation, to talk about compensation, how much money you have, even amongst family members, it's a real no-no. It's frowned upon. It's like talking about religion.
Politics.
Yeah, politics. But when you hire a person to manage your money, you've got to ask the questions. You've got to thoroughly understand how the person that you're hiring is getting paid.
Yep. So fee only is what you want.
What you want.
Fee offset is where somebody's maybe putting you in an insurance policy and rebating the commission. That's a little squishy, not very common. For me, one of the things about getting older that I love is maybe I was always outspoken, but I'm probably a little more outspoken and direct and not, pussyfooting around it. But in this day and age, it's so much easier to set up a business or to work for a firm that is fee only, that the people who are hanging out on the other side are hanging out there because there's a lot more money there. It's a different, and they don't really know how to do financial planning. I mean, the good advisors migrate to fee only. I mean, that's just the way it is.
Yep.
Sorry if I've hurt any feelings there. So the RIA is not really a credential. It's a registration that is required. The certified financial planner, as we talked about, is a license that you have to study for, pass the test, and you have to keep up with ongoing continuing education and ethics requirements. The other designation that you might run across in our industry is the CFA. That's a chartered financial analyst, very well respected, very rigorous program over 3 years just in investments. So we always say that the CFA is deep in investments, whereas the CFP is wide in all things financial. So for example, I have 2 CFAs on my team, but they are not advisors. They're just doing the investment side. My advisors are all CFPs. And when you're looking at a firm, a small boutique firm, any team that you're looking at working with, you want them to have some of these credentials. CPA, obviously a respected credential, may be strong on the tax side as well, and that's a good thing. All the other ones, for the most part, are sales type licenses. And I got this from Mark Prendergast, 240 designations.
Yes.
Crazy.
Crazy.
Yeah.
But people trust, they don't care if they understand what the designation stands for, but people who have designations behind their name come across as more trustworthy.
Yes, and that this is a good time to mention the top 100 list. I would say it used to mean more. Now it's very much a pay to play type of thing. When you look at the Barron's list, it's all brokers. Out of like 100 people, there may be 2 people that are fiduciary advisors on there.
Well, Orange County Magazine does 5-star financial advisors every year.
And it's usually the list of the worst advisors.
Yeah.
No, seriously.
They gave me 5 stars the year that I lost 70% of my portfolio. So it gives you a clue.
Yeah. So that don't, especially in
those magazines they're there for advertising.
Yeah. So we talked about the terms being interchangeable, because sometimes people will say, well, are you a financial planner or a financial advisor or a financial analyst? I mean, these are all just, made up terms. The only thing is, the industry is maybe going to try to regulate who can call themselves a financial advisor, so that brokers couldn't do that. They actually have to be, giving advice. It's super confusing. I don't even know where it's going to end up. But really, this doesn't mean anything in itself. You need the license, you need the designation to really know if they have any particular training in these areas. We talked about this asks first, how you get paid, what services will you provide? Different firms provide different services, so that's important. Some will do your taxes, some will, pay your bills. There's all kinds of different things that firms could do. So what we recommend, or certainly what I recommend, is look for a fee-only fiduciary advisor, a CFP. If you really want any financial planning, the CFP is what to do. Anybody anybody who does financial planning, who does a good job, they love it. They love to talk about it. They love to, get into it, and they are certainly going to be a CFP. It's like it's a calling, it's a passion. The advisor, this is where you can get the website and check, check their ADV form, check their background, see if they have any disciplinary records. Also, for me, this is something that's been very important in the last 5-10 years, is who owns the firm. In my world, there's been in all worlds, there's a huge influx of private equity money. You've seen it a lot with medical practices. I mean, we just dealt with this with a vet who got taken over by a private equity firm, and you kind of see how the services are gutted, the people are fired. Things are changed a lot when private equity takes over, because they have to make a lot of money, squeeze out the profits, and flip the company within a pretty short time. So many firms in my business, most firms in my space, even the fee-only fiduciary firms, have taken private equity money. You can debate whether a little private equity money maybe helps you grow, but if they become the majority owner of your firm, it's going to change the nature of your firm. I've seen that among my peer group the last many years. I'm proud to say that we're shareholder owned. Only the employees own the firm, and we have taken no private equity money.
And that's comes back to, is a small boutique firm more valuable than or safer than a large firm. And the key is that we haven't talked about this, but what role does a custodian play in this financial planning world?
Yeah, custodian's very important. And of course, the Madoff example is always the one that a lot of us talk about because everybody heard about Madoff kind of running off with the money. He made off with the money. And the thing was, he wasn't working with a separate third-party custodian like a Schwab, a Fidelity, even a bank. A lot of the banks are working with some of the independent advisors as a third party. But again, Schwab and Fidelity are the big players. But Madoff had the clients writing the checks to him, to his firm. And then he was making up fake statements, which is a whole different thing. But had he been working through Schwab or Fidelity like all of the rest of us, it never would have happened. He was literally stealing the money. So we don't ever touch the money. It's at Schwab mostly, and Schwab also has some oversight responsibilities on us. They do some screening before they'll even let a professional advisor work through them, and they're watching also like that. So you're taking, not taking 10% fees out every year. Maybe, you're taking 1% or less. So
you have a limited power over the account. And what
right.
are those limited powers?
So we get a limited power of attorney, which allows us to deduct our fee with us showing a statement that how we're calculating that, and we can send money to the client, and we can make trades on the account. We can't send money to anybody but the client without the client's authorization.
So, and do you have any control over Schwab?
We have no control over Schwab.
So Schwab is the institution that holds the client's money. And what does it take for the client to say, "Hey, Laura, I'm tired of you. You're fired"? What happens?
They don't even need to talk to us. They could just choose another advisor and have the money pulled. They could tell Schwab, to pull the money. And we've actually had people move to us from another advisor where they didn't even want to talk to the advisor and they didn't have to.
Yeah.
But it's your money. You have just because we have a limited power of attorney doesn't mean you don't have full access to it.
And that's what makes
not to go on and place trades that we don't know about because it'll mess up what we're doing. But theoretically, you could do that.
Yeah, and that's what makes the small boutique firm, one or two people, etc., just as safe as, or maybe even safer than a Merrill Lynch or a Morgan Stanley or a Ameriprise, etc.
Right. So a small firm with just a couple or few people who is fee only fiduciary and has CFPs on the team can't afford to mess up. No. Or do anything wrong. I mean, that's working with a Schwab or Fidelity, that's a very good way to go.
Yeah.
I always, sometimes people really fall in love with the first advisor they talk to. I always prefer people to talk to at least a couple other advisors because everybody works a little differently. Everybody has a different investment philosophy.
It's like a marriage.
Yeah.
It's you want to make sure that the relationship is there for the long term.
Yeah, and you need to find someone that you're comfortable, talking about everything with.
Yes, you can't hold secrets.
You can't hold secrets, and hopefully it's a long-term relationship that goes on through many life events. So when you go through difficult times, whether it's a health thing or a divorce or
a death.
You want to be able to be very
a kid who wants all your money.
Yeah.
Somebody at a party who wants you to invest in some kind of business. It's just, you've got to have somebody that you can speak to who has your best interest in mind.
Right. And one of the things that we do, we don't typically source private deals for our clients, even though we have very wealthy clients who do a lot of that type of thing. We will vet the deals. And we have one client who is in a particular space where he knows all the players and everybody's always hitting him up to invest. And he's probably invested in 30 or 40 different things. And he'll run it by us. And occasionally he'll tell us he wants us to be the gatekeeper on that. Like, I can't really tell this guy no because I'm on the board with him, but you guys could say you really don't think this is a good idea. So sometimes we're the gatekeeper.
Well, it's the same thing. I can't tell I get it. I can't tell my child no. I need for you to step in as my trustee to say that you will not allow this to happen.
Right. And we do that very often.
Yes.
And we often actually, just this morning, there was a big pre-meeting with the couple clients and their adult child who was getting in a relationship, and they were going to loan money to buy a house. And, we were integrated in that process to look at how to structure it. So everybody was protected, knew what the deal was. An advisor can be helpful, facilitating family meetings like that. It's, I think,
Yeah.
common.
Yeah. And to stop you from doing a bad
Yep.
decision, because when you get past 70, more than likely, if you make a big mistake, you can't go back to work. So, and earn income. So your decisions become more important, and you want to make sure that those decisions are in your best interest. I can't emphasize it enough.
Yep. And there are advisors in our little ecosystem here that would do a one-time meeting for
Yes,
a peek to
absolutely
help
no
you,
charge.
to give you an opinion, or for no charge initially. But even if you are trying to work through, should I do this, should I not, and you kind of want
Yes.
to engage someone to look at the financial consequences of it, they would do that too.
Yeah. It's a vocation, not a sales job. Let's go to yes. The next,
So
this is the one of the most important slides.
So these are the things that a real financial planner can do. And I hear I'm saying financial planner instead of financial advisor, because not all financial advisors really do financial planning. And we call our people financial advisors, but really we're all financial planners because we're very immersed in this. This is the world we came out of. We don't know how to not look at all the pieces of it. And everything affects everything else. It's very integrated. So we're, cash flow planning. What is your spending? We're not necessarily going to put people on a budget. We will definitely tell people to stop spending so much or start spending more. Some very often you don't know what the numbers are, and it's not as easy to figure it out as you think. There are tons of online resources and software to do that, but you have to know what inputs to put in there to get the right answer. And it takes a lot of knowledge of the financial markets and taxes to be able to get the right stuff in there to get the right answer. So
Next week, that's what we're going to focus on.
and cash flow planning, super important, putting together your balance sheet, all your basic documents. And this is not something you do once, it's an ongoing thing. And the first time you do that with your advisor, it's like a baseline, and then you update it as your situation changes. So, and see how much you are spending. And of course, tax returns give us a lot of information. So, a lot of people don't realize they're maybe spending more than they realize they are, because we see it, and we can see it on the tax return. So we'll talk about the documents that you need when you go to an advisor too. But
Risk
capital is a
management.
big part of it. Risk management isn't, another way to look at insurance. So there's more than insurance. So we definitely think of the whole field of risk management, everything to worry about, like cybersecurity and fake, people trying to steal your money, which is a huge thing. And I will just say, just don't click. I mean, we have had incidents. Just don't click on stuff. Don't give anybody your social security number in a text or on the phone. And your kid is very likely not held hostage somewhere. And you should have a safe word with your family in case something weird like that happens. I think that is not a bad recommendation in this crazy world, because now AI can replicate voice. And we have a couple clients that we have that word when we're moving money around, so we know it's real. But risk management is life insurance, property casualty insurance. A good financial advisor is going to review all your property casualty insurance. Huge issue in Southern California. Lots of people canceled the last couple of years. Obviously, big repercussions there. So we're looking at that, liability insurance, business insurance, all of that.
Tax planning is something that people think that a CPA needs to do. And in real life, I find very few CPAs do tax planning.
Right.
Talk
And
a
the
little
other
bit how important that is.
Yeah, so tax compliance is actually doing the tax returns, and most CPAs are overworked doing hundreds of tax returns. They're just getting the tax returns done. Ideally, we're working with the CPA on the planning throughout the year, and it's a great partnership if you have a good financial advisor who's gonna do that. And the financial advisor do a lot of the legwork. The CPAs are usually pretty happy about that. doing the planning. We'll be able to talk a little bit more about what some of those things are. It's just so important in this day and age. And of course, the tax law, whether it's sunsetting or not at the end of the year, is completely up in the air. Very hard to make certain planning decisions, but it's something that you should do all year round, not just think about it at tax time. We'll talk about that.
Just on the tax planning alone should justify the financial planner's fees.
Yeah.
But, you know,
Yep.
and we're going to get more into detail in a little bit, but most people believe that when I hire a financial advisor or a financial planner, it's about investments.
Yeah, no. So, I mean, and I always say it's kind of the most important thing we do, the investments. It's the
Yeah.
engine that drives everything, but and then the other hand, it's the least important. And I'm thankful I have a dedicated team doing the investments here. So the rest of the advisors are more focused on everything else and how that intersects with the investments. And we always say that the way that we manage investment for portfolios is so tax obsessive that we're making up for our fees just on the taxes that you save on the portfolios. And we have clients who do have accounts elsewhere. So we see how we do tax-wise, how we do performance-wise and tax-wise compared to some of these other firms. The brokerage firms and the banks are really not usually paying much attention to the tax effects of the moves they make. Huge difference, especially over the long term.
And we're going to have an entire session on investments.
Yep. I'm going to just have two little things I have to say about investments in it. And retirement employee benefits. That's something we will help the clients rebalance their 401ks ongoing. Lots of stock option planning and that sort of thing that we can do. Help them set up a retirement plan for the small business, all of that under retirement employee benefits. And then, of course, estate and charitable planning. Very important, something that changes. It's not static. If you did your trust 20 years ago, you probably need to relook at that. But that's something a good financial advisor is going to get involved with too.
And I would recommend highly that you get your financial advisor to communicate with your attorney, estate planning attorney, because your financial advisor should know your family pretty well and who's going to be a successor trustee and giving to charities if you want, or who amongst the children should maybe be have special trusts set up. So it's a team approach.
Yep. And I think most attorneys are very glad to have that help. We most often will be in the meetings with the estate planning attorney. We always want to review the trust before it's signed. We usually find some things that would be, good to be tweaking. And I think I would ask your advisor, would you, be involved in that with me?
It's not a silo world. You got your CPA, estate planning here, financial advisor. You've got to have them communicate with one another. No one can know all of this.
Yep. So clarifying your goals will be important going into the financial planning meeting. You're going to have a session on that next week, but there's lots of goals you may have, one or two or many of these things. Again, I do want to keep moving here because we have a lot more to cover still. But you'll be needing to bring information and don't hide it from your advisor. You need to give them your statements, your tax returns, your W-2s, your insurance policies, all of that. Super important is getting all that information together. Again, I think there'll be more time spent on that next week. And here, I just have to say two things about investments. I'm sure you will hear this from others in this series, but I can't say this strongly enough. Very, very, very rare exception where this would make sense. Annuities are sold because it's the highest commission product, easiest sale, and they are impossible to get out of, super expensive, bad tax effects. Just say no. Other investment recommendations, just real quickly, I would say most people should avoid cryptocurrencies. It's speculative. It's not really considered an investment in our world. Insurance products, non-traded real estate investment trusts. If you don't know what they are, good, stay away from them. Structured products where they can protect you on the downside, but give you some upside. Very costly. You get locked in. They don't necessarily do what you think they're going to do. They're sold by the Goldman Sachs and the big brokerage firms, all those guys. Gold and precious metals, again, we don't consider that as part of the investing suite that we would look at. Private limited partnerships, any private deals with K1s, you can't get out of them, high commissions, high costs. And for most people, we don't think individual stocks are the way to invest. So just that, enough on that. So taxes. The other thing that we, is in addition to the intro, we want to spend a little time on income of taxes. And there are so many types of taxes. I started listing all the types of taxes. I think there's too many. So just
you didn't put tariffs down here.
yeah. That would be good. Yeah. How did I miss that? There's many other types of taxes, transfer taxes, different types of things, but income taxes, of course, we all know.
You should everybody know their income tax bracket?
Yes.
Yes.
Or your advisor should.
Yes.
Or at least your advisor should. That's why if your advisor's not asking for your tax return, you're really not getting the full Monty there.
Yeah.
Capital gains taxes when you sell an asset, different tax rates, different type of tax. Social Security taxes, you're paying taxes while you're working. Your Social Security is also taxed kind of in a separate calculation when you're receiving Social Security. And then property tax is a big item in California, and there have been some changes there we'll touch on briefly. And then estate taxes. So the income tax, property tax, and estate taxes and the capital gains actually kind of all intersect and tie into how you do your estate planning. So kind of important to have somebody who's understands this and is paying attention to it. The taxes matter. Your tax bracket matters. We'll talk about that in a second. Timing your taxable income, if you have the ability to do that, if you have a business where you can time some of your taxable income, or if you are pulling money from retirement plans and you could time that, that can help your planning. Understanding the ordinary income versus capital gains tax, what your adjusted gross income is affects other things. And then maximizing charitable gifting strategies. For most people, cash is not the best asset to give, though cash is very welcome from charities. Usually gifting appreciated assets is pretty easy these days and gets you more bang for the buck. And then the power of the step up in cost basis, extremely important in estate planning. If you die, your assets get a step up in the cost basis, and you get out of income taxes, basically, if you die, except for annuities. You don't get out of them in annuities. You pay it still in annuities.
Give you an example is that just the ordinary income versus capital gain. A single individual can earn close to $50,000 in income and pay zero tax if it's a capital gain.
We'll get into that. We'll just,
Okay. I just want to let you know we got a little over about 20 minutes.
Okay. Just the tax bracket planning, which we'll talk about a little bit. Tax loss harvesting the investment portfolio. So, I'm looking at now we're in this period of extreme volatility, and similar to what happened at the beginning of the pandemic when the markets were going crazy, and we were rebalancing like mad as when the market was falling, because we knew it was going to end at some point. It's always going to end at some point. Either we're all going to get blown up in a nuclear holocaust, or it's all going to end some way. And you want to take advantage of the volatility to reposition your portfolio, make sure that you're in the right place portfolio wise when it turns around, and also to get lock some tax losses. And that happened during the pandemic, where we booked a lot of losses. And who knew? Who would have thought how quickly and how big the market came back? So we ended up with a big positive year and tax losses we could use. It was perfect. Batching your deductions in 1 year if you have choices, like with your charitable giving. There's some planning around that. So if your CPA is not doing this, having an advisor who can help you look at those things, very important. We love DAFs, donor advised funds. You're going to have a session on estate planning and some of those charitable gifting ideas. Qualified charitable distributions, great vehicle for giving money out of your IRA account, whereas the minimum distribution age has been increased to age 73. The age to be able to do a qualified charitable distribution is still age 70 and a half. And you could give up to, I think it's
108,000.
8,000 this year out of your IRA. With no tax effects, directly to a charity. Most advisors can facilitate that very easily for you, to several charities, etc. Roth IRA conversion. We'll talk about that in a little more detail. But as far as the tax brackets, and I stole this chart from Mark Prendergast and updated it for 25. And we're highlighting the red bracket because we're going to show the difference that a tax bracket makes by looking at another slide in a minute. But your tax bracket is the marginal rate. That's usually referred to as your tax bracket is the marginal rate. It's the rate that you pay on the next dollar of income. So if you're making, 500,000 a year and your marginal rate's 33%, that doesn't mean, or 32%, doesn't mean you're paying 32% on the whole thing. Your effective rate is a combination of the blended rates that you're paying in each tier. So if you're in the top tax bracket of 37%, maybe you're only paying a 31% blended rate. But your marginal rate is what you want to look at when you're thinking about investing and buying and selling for capital gains. So here you can earn as a married, this is just married filing joint for this example. If you're earning under 23, earned income, taxable income is under 23,850, you pay no tax and then you start to pay 10% on the tax rate over that. So that's how that works. But this is 23,000 of income puts you in the 12% marginal. But to get into the 24% marginal tax rate, you have got to have over 206,000 of income. Huge difference in those tax brackets. So there's planning in between the brackets. So what we talk about is if you're in a certain tax bracket, we may have you take income up till when you would go in another tax bracket. So we may accelerate distributions from your IRA, for example, in a year when your income's lower to use up that tax bracket. I mean, those kind of things, an advisor can save you so much money by helping do that. And CPAs really, in our experience,
don't help
get into that. But also just, this always makes me just like how high those income levels are for those tax brackets. Everybody thinks they're in the highest tax bracket. Very few are in the highest tax bracket. It's a big number. Long-term capital gains, any asset held for 12 months or more is taxed at a lower rate than short-term gains, which are taxed at your ordinary income rate. So the rate that you pay on capital gains taxes is determined by your overall tax, not just the gain on that item. So if you sell a rental property, the capital gain calculation is not based just on the value of that gain on the property, but your whole tax bracket. So if let's use married filing jointly, you can pay zero capital gains up to 96,700 of taxable income. So a lot of people can fall into that bracket where they can sell stuff and not pay capital gains. However, California is different. This is just federal. I will say California gets you either way. So that's an interesting planning opportunity there as far as how you manage the portfolio. So that's why, ideally your investment advisor needs to know what tax bracket you're in, because it may determine whether they take a gain, or if they really want to sell that thing and they're going to take a gain either way, maybe they wait till the next year and push it off a year, do it in January instead of December. The other thing that's just interesting here, I think, is the estates and trust rate. You see how quickly those tax brackets jump up to the maximum 20% bracket. So for a single person, it's 533,000, but for a trust, it's a little more than 15,000. So there's planning if you have an irrevocable trust and you're getting income from different sources. Lots of planning that can get more complex. Definitely need an advisor. Just as far as taxes, of course, income from an IRA, distributions from IRAs, 401ks, other retirement accounts are taxed as ordinary income. And that's where you can do a qualified charitable deduction. But distributions from a Roth, as you know, I think are tax-free. So the IRAs are tax deferred. You don't pay taxes until you pull out. But a Roth, you never pay taxes. And if you do it right, when you pull out, you're not paying taxes. So Roths are very desirable if you can get them. And in order to contribute to a Roth, you have to meet certain you have to be under certain income thresholds, but you may have the opportunity to convert regular IRAs to Roths. And just to note, Social Security benefits can be taxed up to 85%. You hit that 85% rate, I think, at 34,000 of income for married filing jointly. So pretty fast you hit that rate where you're paying tax on 85% of your Social Security.
Yeah, you don't pay 85% at 34,000, but it graduates up.
Right. So the Roth can, and just to the state tax, and we'll talk about Roths, but the state tax exclusion right now, you can give $19,000 to anybody. Husband and wife can give 38,000, 2 times 19 to any person, and not have
without filing an income gift tax return
or paying. You don't pay taxes.
and
You
no
don't pay
taxes.
taxes on it. So that's a great way to, if you're trying to reduce your estate or get money to people to help them. You have a lifetime exclusion right now of almost 14 million per person. So married couple has just under 28 million. That's the one that's scheduled to go away at the end of the year, which it may or may not. So that's we'll talk about that the sunsetting of the tax law in a minute. Just another thing on the step up in value, huge benefit to passing on assets to your beneficiary. Separate from the estate tax, you avoid the income tax by dying, but you may still have an estate tax or not. Some specific rules around that, which is important to understand in planning when you're doing estate planning. You'll have some more on one of the last sessions on that.
Yes.
Just a thing on Prop 19, because it affects a lot of people here. Proposition 19 passed a few years ago. Everybody thinks people didn't understand what they were voting for. But basically, you used to be able to pass on your property to your beneficiaries and not have a reassessment on property taxes. That's no longer true. Post any exchanges post a couple years ago. If you transfer to your spouse, no increase in property taxes. But if you transfer to a child, the child can only get what the current tax base is that you're paying taxes on, plus $1 million in value. So if you bought your house for 1 million and now it's worth 3 million, you're paying taxes at that rate, property taxes at that rate, and it's worth 5 million. When you die, the kid would get 3 million, the base, plus that extra million, 4 million. And then the rest they would pay the increase in taxes. That's if they live there. They have to live there. So the kids can't accumulate all those rental properties and not pay taxes like everybody else. People were not really happy about that once they understood it. It's tricky. You can't just put your kid on title without having consequences. One is probably a tax reassessment, property tax reassessment, and you've given a gift, and you probably need to file a gift tax return if it's over. Of course, it will be over the 19,000. So lots of issues around transferring. You can't just put people on accounts without talking to
title. Very important
about the consequences. Roth conversions, converting your IRA to a Roth, so you move your taxable thing that you're going to pay taxes on at some point to a tax-free thing. Great concept. However, what you're doing is you're paying the taxes early before you have to, which is always like maybe not a great idea unless you can do it in those low tax brackets. If you could do it at a very low tax bracket, if you're in a low tax bracket for a particular year, or you think you're going to be in a higher one, like right now, tax rates are scheduled to go back up, though they're probably not going to. You might want to play around with doing the Roth conversion analysis. Any financial advisor should be able to do the Roth conversion analysis. So we have clients that are doing a little bit each year to eat up a bracket and at a low rate, but it more often doesn't make sense.
A good financial advisor is a good number cruncher, because you have to crunch the numbers in order to determine what's best for you. You can't just assume in your mind that a Roth conversion is good for you without running the numbers.
Yep. And we have lots of tools that help us do that also. Roths are not good if they're going to charity. That's not a good option. And if you're in a higher tax bracket later, that could be a good idea. There's different issues around kids and how you gift that in a Roth. I want to kind of get through this last bit on the income tax cuts. So the 2017 tax cuts that took effect in 2018 are supposed to go back to where they were at the end of the year. However, it seems right now that the House is that they're going to be able to get it passed to keep the tax cuts in place, but who knows, which makes it really tough for planning. So if they keep them in place, we're in these slightly lower tax brackets, but right now we have the cap on the SALT tax deductions where we can't deduct state taxes, which in the high tax states, California, New York, et cetera, is a big negative. So they may bring back the SALT cap. They may cap it at 25 or 30,000. I've seen different things. Who knows about all of this?
By the way, but you make a really good point. No one knows. And there's a lot of people who will come on the air, on the media, and sound like they know exactly what's going to happen. They don't. You have just as good a guess as anyone as to what Congress is going to
Yeah,
do.
and if the last few months is not a great example of that, what is? I mean, we don't know what.
Don't let anybody convince you that they know what's going to happen. No one knows.
The qualified business income tax deduction is a big thing. I will say we have a multi-$100 million client who was with a tax advisor in a different state who had not been taking that on 12 or 14 entities, but the good financial advisors found that crazy. So yes, we're supposed to revert back. One of the big things for people who have large estates is if we revert back, we lose that 14 million of assets we can have estate tax free, and it will go to about half of that.
You got about 5
still a
minutes
big
left,
number.
Laura.
So just my final, this is like a lot of things that you're going to have in the next sessions, but these are some of my takeaways, recommendations for financial success. Obviously, we've made the point, work with only true fiduciary advisors. Don't pick stocks, focus on the asset allocation. You'll have more on that. Don't try to time the market. Make sure you're paying attention to taxes. Maximize your contributions to retirement plans while you're working. Don't buy annuities. Don't borrow to spend. Don't buy on margin and leverage your assets, except for a mortgage. Home mortgage interest is a good debt. Save using 529 plans for college, for kids or grandkids. Have a will or trust. Keep it current. Don't worry about the wrong risks.
Yes,
when that's a whole section.
That's a whole another topic. The wonderful thing about this, by the way, this is a great outline. So thank you, Laura. That's super because it gives everybody kind of a starting point. You mentioned annuities. I just want to make the distinction between a charitable gift annuity and a commercial annuity. They're two different animals. We encourage you to look at a charitable gift annuity, but not at a commercial annuity. And then even then, some fixed commercial annuities may be appropriate in your estate plan or in your financial plan, but make sure that it comes from a fee-only advisor,
right?
Not from
and the
somebody.
Rates are pretty good. Not
not somebody who's selling the annuity.
Right.
There's a question regarding how many times do you meet with your clients on an annual basis, and is there a limit?
That's such a great question. Every advisor is different, and some have a set thing. Ours is really on a per client basis, something we work out with the client. I would say in the first year, we're meeting several times. I would say, 3, 4, 5, 6 times. And then once we've worked together for a while, we typically have a more formal meeting 2 or 3 times a year. 2 would probably be the most common. And yet we're talking to our clients all the time.
So, and it's also driven by special events within the family, and questions that arise.
And there is no limit. And I think most advisors would say there's no limit.
Yeah, I don't think there's an advisor that we're going to be speaking that has a limit. So it's based on your comfort level. It's kind of a relationship. You have to build the trust.
And the more you communicate with your advisor, if there's stuff going on or you have questions or concerns, the advisor is going to like that. The better it is. Don't do the thing and, don't do it and then ask forgiveness. Like talk about the thing before you make a big decision, or if you're concerned.
And if you're going to do it yourself, that process, that one slide, cash flow, risk, if you could answer those questions yourself and put them on a sheet of paper, that would really help you out. Okay. And most of the fee-only advisors do not charge for a first meeting. And many a time they'll help you out with a situation if you have it without any obligation to pay them. It's the fee-only fiduciary world is a very compassionate and underutilized and underappreciated world, because you there is no mass media that the fee-only community can use. The Merrill Lynch's, the FINRA's, the Morgan Stanley's, BlackRock, uh, these are conglomerates. They have so much media control, and you want to stay away from that, at least in my opinion. We have 2 minutes left. You um, want to, let me do this. We're going to sign off. Thank you, Laura, for
Yep.
the video. We appreciate your presentation today.